Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. So today we're going to be looking at a well-known British brand called Greggs. What we're going to be doing with Greggs is we're going to be looking at its annual statement. We don't often go into the quarterly statements, but what you're going to learn in these videos will help you analyze those quarterly statements faster and with more detailed analysis. So don't forget to like, share, and subscribe for our videos so that you can get access to more of those videos that we publish. So let's get on to Greggs. For any of you that are not in the UK, this is a well-known brand, a British bakery brand in the UK, mostly focused on savoury products. Now, the company was founded in, let me check my notes, 1939 in a city called Newcastle, which is just north of the UK, north of England. And right now, they have around 1,953 stores with 20,000 employees, so quite a sizable business. And they serve 6 million customers per week. Now, they're famous for their sausage rolls. So here's some stats on sausage rolls. They sell 2.5 million sausage rolls per week, which is a sizable number. They're also quite known for their donuts. And statistics show that they sell 50,000 donuts per hour in the country. So they seem to satisfy a lot of the UK's palate. So very interesting business. And this was a request from one of our viewers. So be active. Here is your video. Thank you for making the request. And by the way, you too can make a request as well. In fact, probably about 95 to 98% of our videos and the companies we analyze are requests from our viewers. So if you do want us to analyze a company for you and you're interested in them, do leave a note in the comments section and put some context behind why you find them interesting, because the more context, the more interest that provides for us. The more interest means the more likelihood that your video will be prioritized. So do leave a note in the comment section. Before we go into the finances, and stick around for a bit more detail about this, because this is going to be great context for you. Just a quick note about the shares on this business. So in the last, they floated in 1993. If you'd invested in that time, you would be sitting on a profit of around 3,900%. So benefit of hindsight, as Ted always says. If you invested 5 years ago, your shares would have been up about 117%. And in the last year, your shares would have been up 1.7%. So stick around towards the end, because we always look at those numbers and the share price and the movement, just to give you some context around the finances and the fundamental financial statements. So with that, Ted, over to you. Let's share what we found about this business and some information around how they kind of fared during the COVID pandemic and the lockdowns.
Excellent. Okay, so good to see you, Moeed. Thank you very much indeed. Hello to all of our viewers. As Moeed says, we're going to jump straight into the annual report and accounts now. The annual report and accounts, the latest audited, so kind of checked by an independent auditor, are January 2021. But what we do have here is the preliminary results for the 52 weeks. So that's the year ended 1st of January 2022. So don't forget, this will be looking at the 2021 year of account. Commentary on how the company has performed. I'll leave, if you are interested in that, you can download this off their website. We are going to whiz through and look at the underlying numbers. So here we can see the income statement for Greggs. This is showing the income and the costs and the profit. So the first thing we notice, sales up significantly. They've increased their sales year on year by about 52%. Now, do bear in mind that we're looking at 2020, obviously time of lockdown and the pandemic. And so lots of people weren't in the offices, and so they weren't popping out to their local Greggs at lunch. And so we'd expect that. In fact, 2020, it was a 31% reduction on 2019. So if we were to compare this 1.3 billion of turnover, this 1.2 billion of turnover with 2019, it was 1.168 in 2019. So 1.168 gone to 1.229. So a small increase on 2019, which is probably our kind of the closest normal comparison. Gross profit is up, so quite a healthy 64% there. So you can see those sausage rolls, they're selling those sausage rolls, and the cost of selling those sausage rolls is in there. And basically what this is telling me is that for every pound you spend on a sausage roll, it costs them 36p to make the sausage roll, and they get to keep 64p. So really, really high profit margin for this business, and that's kind of the attractiveness of it. You'll see lots of bakeries around you, usually independent, and Greggs has been very good at kind of taking a formula and starting to kind of to grow and to create this chain. And they are very, very much focused on footfall. So they look at where do people travel, where do they get the highest footfall, and that's where they're going to put their stores. Then the cost of those stores, that's kind of distribution and selling costs, and the kind of the administrative costs. These are all the costs of kind of effectively in running the business are in there. So that's another 51% or 51p in the pound, which leaves them with an operating profit of 153 million. That's about 12p in the pound. So if you spend £1 on a sausage roll, what they're really saying, it costs them 36p to make the sausage roll, which is pretty low, but then another 51p to run the business that makes the sausage roll, if that makes sense. So those would be all the kind of cost of the stores, cost of the staff in the stores, rent, rate, light, heat, and all that kind of stuff, as well as some of the head office. And that brings us down to the kind of the profit before tax, 145 million. I'll just clear my annotation and we'll just scroll down a little bit so we can see the bottom line. And there's the bottom line coming into view now, which is 117 million. And you'll notice that from the previous year, they made a loss of 13 million. 2019, they made a profit of 87 million. So the profit 2019 to 2021 has increased, but obviously it dipped 2020, but that will be pandemic related. And that's really the income statement. So nothing really surprising there. Pretty healthy. This is about a 10%. A 10% bottom line margin. So every 10p in the pound, every time you spend, you buy a pork pie or a sausage roll or whatever it is you're buying from Greggs, a donut, as Moeed said, every pound you spend on a donut, the company gets to keep 10p in that pound. That's a kind of approximation. Obviously that'll be across the board, and if you're working at Greggs, you'll kind of know that there's different products will be have different profit margins attached to them. So there's our income statement. Trading, they're back up and trading, which is good. They're back up and trading profitably. Let's look at their balance sheet. So here we're looking at the assets of the business. The non-current assets, a little bit of intangible. This is going to be, perhaps goodwill. Where if they bought, maybe they bought another chain of shops, for example, and they kind of amalgamated them. Maybe other bits and pieces, I don't know, software, for example, in there. Really, the big numbers are property, plant, and equipment, 343 million. It's not massive, don't forget, because they'll rent most of their stores. But what they do also have is right of use assets. So this will be, I don't know, sausage roll makers that rather than buying them outright, they will have, bought them on a hire purchase, and they'll just be reflected in that. So whether they've actually bought their sausage roll makers or they've rented the equipment to make their sausage roll makers, those are kind of reflected in here. So there's not unlikely, I mean there may be the odd bit of property in there, but it's unlikely to be a lot of property, probably mainly going to be plant, so the equipment for making stuff and equipment and computers and point of sales machines and all that kind of stuff. Current assets, we got the inventories. So those are the kind of it's not not a lot of inventory. And just for those of you who are interested, if you were to calculate the inventory turnover, inventory days, it works out at about 21 days, which is quite surprising. And a lot of that will be therefore raw material. They'll have sacks of sacks of flour, for example, and sausage meat, kind of, and then they kind of put that into their, and they freshly make it. And I think what they make on the day they sell, I don't know what their policy is for stuff which is left over at the end of the day. Often you'll find companies like this will give it away to local charities and homeless, etc., etc. Trade receivables, surprising to find trade receivables. Very few people walk into a Greggs and say, add it to my bill, I'll pay you at the end of the month. Trade receivables works out at about 11 days, and you'll probably find that there's a few corporate accounts in there, but mainly this is a point of sale. So you'd expect them to have very strong cash flow, and there we can see they're actually sitting on a fair amount of cash, £200 million worth of cash, and even in the pandemic they had a reasonable amount of cash sitting there. So total assets, £888 million. Scroll down a little bit further and we can see the liabilities of this company. So here are the liabilities. Now, the thing we do notice here in the liabilities, no debt. So these guys are debt free. Looking at the current liabilities, these are things that they owe and have to pay soon. So they've got some trade payables. So this will be, the flour and the sausage meat that they bought from their suppliers, they haven't yet paid for. Interestingly enough, again, if we look at their working capital requirement, we can work out that it takes them on average 98 days to pay their suppliers. Now, that sounds quite a long time to me. And if there are any people who have experience of supplying to Greggs, you might let me know whether that is an accurate reflection. You may have some distorted numbers in there, but as a general rule, that's 98 days to pay the suppliers. And EU Directive 711 says you have to pay within 60 days. But, the summary is that these guys, they're getting the stuff in, they get the flour in, they turn it into sausages, sausage rolls, etc. They get the stuff in for the donuts, all that sugar, they turn it into donuts, and then they sell it pretty quickly and they get the cash in, and they're paying their suppliers much further down the line. So the business model they operate has very, very strong cash flows. They've got some really good, strong cash flow, and we'd expect to see that in the cash flow statement. And part of that will be why they probably have very little debt. They don't have any debt. What they do have, though, is lease liabilities. That's these two numbers here. And these are the liabilities together that sit behind, if you remember, those right of use assets that we saw. So, they show, here's the sausage roll making machine that we've sitting on our balance sheet. We've got it on a hire purchase, and here is the liability to the people who have provided that hire purchase agreement effectively. And there's really nothing else kind of jumping out at us. Those are to trade payables and lease liabilities. That's basically it. That basically makes up their total liabilities, 460 million, which gives them net assets. That's the assets net of the liabilities of 429, or effectively 430 million. A little bit up on the previous year, 321 million, and just for comparison, 2019 it was 341 million. So the company's growing, and even in the pandemic the company is continuing to grow. So let's just check our here we go. So we're just going to scroll down, just check our capital, so the equity. So the equity which is funding this business, as I said, there's no debt here. So really it's all being funded through retained earnings, and we can see here that there's the profit that they've made. There's a fairly significant increase in profit, although you'll notice, if you remember, they made 117.5 million pounds in profit, but the retained earnings has only gone up by 100 million pounds, or just over 100 million pounds, suggesting that they have paid out a dividend. So we'll check whether that is correct. You'll also notice that there's a share premium account. This has increased a little bit, suggesting that during the year maybe they issued some shares in order to kind of secure up their finance. So a lot of companies during the pandemic were going back to the shareholders and saying, look, we need a little bit more investment in order to see us through these tough times. But this is looking pretty strong. It's an equity funded business. There's the balance sheet is they've got lots of cash, 200 million, looking a pretty strong and comfortable business. Here is the movement in equity. So if we look at if we look at this column here, this is the retained earnings column, and then we just scroll down to the relevant year, because the first bit is the sort of the previous year. So here is this year, and we can see there's the 303 that we start with. There's the profit during the year. In fact, I'm just going to scroll down a little bit further. So let me just do that. And we notice down the bottom, we can see there's a little bit of share buyback. That's quite interesting. There's a bit of share buyback going on. And here are the dividends paid out to the shareholders. So we see the the dividends. So 117 million pounds in profit, 15 million pounds being returned to the shareholders. So the company is holding on to a lot of that and is reinvesting back into the business. And we can see, as I mentioned before, there's a little bit of sale of own shares. Not sure exactly why they're that almost looks like they're trading. So this is not a really kind of a significant movement in the equity. I'm not sure exactly what decision making was sitting behind that. So these guys, they have the potential to be paying out 117 million pounds in dividends. They're clearly holding on to substantial amount of that profit, partly to continue to strengthen up their balance sheet, and also no doubt to fund future growth. So it'll be interesting to know what their future strategy, where they're hoping to kind of invest that money. Here is the cash flow statement. So this last little bit is the cash flow statement. We are first of all looking at the net cash inflow from operating activities, 285 million. So this is the cash equivalent of their operating profit. Now, you may remember that operating profit was 153 million. So this is just reflecting the fact that this is a very, very strong cash generating business model. And even in the previous year, in the pandemic, even though they were operating at a loss of 7 million, they were still able to generate 44 million in cash. This point up here, restated, just says that the 2020 accounts, which have been signed off and audited, they've actually found some things which weren't quite right, and they've had to go back and restate those numbers. And they often see they can see they had to kind of revisit those numbers, and sometimes you see that. Bit of investment, so buying property, plant and equipment. So that's kind of the growth of the business. You'll notice that that is looking pretty healthy. They are, again, they're easily able to fund that out of existing cash flow, so they're not having to go to the bank and borrow money or raise shares in order to fund that acquisition of property, plant and equipment. So so we've got 17 million is going in dividends, 50 million is going in investing in the business. And then if we just scroll down to the bottom part of the cash flow, we will see what they are, how they're financing the business. So there's the share issue and the share buyback. So my mistake, get it the other way around. There's the share issue. There's the share buyback. Here is the dividends that we mentioned before, and they are paying down their leases. So these numbers here is the repayment of leases. And you'll notice here, previous year, they borrowed some money and then they repaid it. So they did have a loan last year, but they managed to pay it off pretty quickly. So this will be, again, probably a loan related to the pandemic. So cash at the end of the year, 200 million, up from at the beginning of the year. They had 36 or 37, which was the end of last year. So previous year, cash went down overall, which went from 90 to about 40. And then we start with 40, and 40 increased to 200. So it really looks to me like Greg's has kind of, they said, we're not going to pay a dividend this year. We're going to hold on to the money. We're going to just reshore up our finances. We're not sure, are we out of the pandemic? Is it all gone? you know, looks pretty healthy. And you kind of think, well, if people do start going back to the offices, if we do start to see that kind of that growth in you know, sort of, you know, activity in the city centres, then there's no reason why they shouldn't start to grow even more. And you know, there's the opportunity, if they can't find any good investment opportunities, either they're going to use that surplus cash to grow the business even more rapidly, or they're going to start to increase the dividend that they give back to the shareholders. So you know, really looking all pretty you know, pretty positive, pretty confident, and also, I guess, reflecting the kind of the resilience. You know, it's like you can have a pandemic, but quite frankly, nobody's going to keep me between me and my Greggs sausage roll on a regular basis. That's not my personal obsession with Greggs sausage rolls, but I'm sure there are a few people out there who quite like it. So with that in mind, let's have a look at their share price. So here's the share price today. As Moeed said, as you said, you know, if you'd invested, if you'd been in at the right at the beginning, with the benefit of hindsight, if you'd filled your boots here, you'd be sitting on a very, very nice, healthy profit. What we're going to see here probably is a kind of pandemic. And then a buying opportunity. Interesting, it's come off. It probably kind of, I guess what's happened here is it's just got a little bit too toppy up at the top here. So if we kind of, you know, we take our chartists approach, sometimes people kind of put a chart in like this, and if we kind of look at it a little bit like that, we look at the trading pattern, it looks like it may kind of drop a little bit further, and then there's an opportunity to kind of trade up in this kind of area here. So, you know, if something gets a little bit expensive, it tends to blow off a bit. But I reckon my personal feeling, Greggs is probably a pretty defensive stock. It's a little bit like McDonald's in that, and what I mean by that is that, you know, we do have the cost of living, and we do have the sort of problem, and you know, but for a lot of people, Greggs will be that kind of that you know, the almost below the radar, that little treat, quite like, you know, that kind of that sausage roll, like the sort of donut, you know, on a sort of Thursday or a Friday into work or whatever it is, you know, and I think that Greggs will be surprisingly resilient. I guess the question for them is whether they can, you know, they're going to experience supply chain pressure in terms of prices. You know, that's going to be inflation, and they're going to need to pass that on to their clients. And you know, they've got the margin to absorb it. They can certainly, you know, they can continue to sell the sausage rolls at the price, so they can maintain their kind of position at that part of the market. But that's obviously gonna shrink their profit margins. So you know, that's kind of the you know, the deal PE ratio, 20 times earnings, pretty expensive, but the dividend yield is only 3%, and that dividend yield, don't forget, is actually quite low. If they were paying out all of their profits as dividends, then the dividend yield would be very, very high. So the price to earnings ratio is, you know, is pretty high. 20 times earnings is about a 5% yield. If you look at the earnings over price rather than the price over earnings, it's about 5%. But no, that doesn't sound unreasonable. So I think that, you know, once again, Greggs, it looks a well-run company. There's no obvious risks screaming at me. Not to say there aren't always risks within a company, but there's no obvious risks screaming at me. And I think that this is, you know, probably you know, something which I would tuck into a diversified portfolio, and I'd probably just, you know, tuck it away and not look at it for another 5 or 10 years. And I would hope that, you know, if you look at it, you know, 5 years ago, for example, 2012, for example, you know, if we look at it here to here, you'd have seen us as sizable. So the question is whether we can continue on that projection for the next 10 years.
Sounds good. Sounds good. So love to hear everyone else's thoughts. And if there are any people that are very familiar with Greggs and its business model, we'd love to hear from you. Do leave a note in the comment section. Obviously, be polite and professional, as we always are. And yeah, love to hear everyone's thoughts. So again, do like, share, subscribe. Leave a note in the comment section if you would like us to analyze a particular company. So make your request with some context behind that. But until the next video, thank you, Ted. Thank you, everyone. We'll see you on the next show.
Catch you later, Moeed.